All right. Thanks to the organizers for having this paper on the program. I do not thank you for making me follow Will's incredible presentation, but I will do my very best anyway. All right, so this is something completely different from what we just talked about. So we'll make a little bit of a 180-degree change here. This paper is titled Social Media as a Bank-Run Catalyst, and this is joint work with Tony Cookson, Corbin Fox, Javier Gilbazo, and Juan Imbet. All right, so this clicker hopefully does. Okay. All right. So in traditional models, bank runs are sort of a self-fulfilling prophecy, right? If we're in the good equilibrium, then depositors generally have a relatively low belief that there will be a run, and so the probability of an actual run happening ends up being pretty low. If we're in the bad equilibrium, depositors think that other depositors will run. That gives them an incentive to also run, and so the probability of a run ends up being high. But how do we end up in this negative and this bad equilibrium? Well, the literature has argued that depositors can coordinate, for example, around so-called sunspots. This can happen through communication, through word of mouth, with people that you know, through social networks with the people that you're connected to. And those are all different sort of mechanisms that the literature has pointed to. What we do in this paper is ask the question if social media as a sort of new platform, a new technology for communication and coordination can similarly sort of amplify classical risks of bank runs that we're familiar with, that we know about from the literature. Of course, our analysis is motivated by and centered around an event that we're all very familiar with, which is the recent failure of SVB, Silicon Valley Bank, in March of this year. People were quick to point to social media as an important force in this collapse. Senator Mark Warner said that this is the first social media internet bank run in U.S. history, and even Janet Yellen went so far as to say if a bank has an overwhelming run that's spurred by social media, the bank can be put in danger of failing. Right, and it's important to put this in context and remember that this was not kind of a small event. If you look at this chart right here, you have sort of a summary of the size of the banks that failed throughout the last couple of decades in the United States. Of course, you have a lot of banks failing right around the time of the financial crisis in 2008. But these last three bubbles that we have right here, with the failure of Silicon Valley Bank and First Republic, are actually pretty large and impactful and not insignificant bank failures that we had around this time. And this is also reflected in what Jerome Powell said around the time, saying that a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. So this is a big event that did not only concern Silicon Valley Bank. And consistent with this, or in a survey that was conducted around the same time, around half of the people in the United States that were surveyed here said that they were concerned about the money that they had in their bank accounts around this time. All right, so what do we do in this paper? What we do in this paper is we start by collecting comprehensive Twitter data. That means we're collecting all tweets with hashtags concerning bank stocks. So that includes, for example, Silicon Valley Bank with a little $sign in front of it. In addition, we also collect other tweets that mention these banks by name or by other references from basically 2000 until the end of the first quarter of 2023, until the end of March 2023, plus the details of the users posted these tweets. And what we then do is study the relationship between exposure to social media and different outcomes during this period around the failure of SVB. So we call this first period the pre-run period, in which we can observe the exposure of different banks to social media more broadly. And then we'll study different outcomes during this thing that we call the run period, which are the days around the failure of Silicon Valley Bank. We do this by mainly focusing on stock returns, simply because we can observe those at a high frequency around the time of the failure of SVB. And then we conduct three different types of experiments. Our first type of experiment takes sort of a cross-sectional perspective, where we try to relate the exposure to social media and Twitter during this pre-period when there was no mention or no indication of any bank run to outcomes around the time of Silicon Valley Bank, in particular the stock price declines and bank stock losses. We also look at quarterly deposit outflows over this period of time. And then we go further and look at a little bit more high frequency outcomes here, looking at hourly changes in stock prices for these banks around the time of SVB's failure, and then even more high frequency, sort of the individual impact of individual tweets at sort of a 10-minute interval here. All right, what do we find? Well, first of all, we find that exposure to social media from this pre-period predicts that banks with high exposure had higher losses during this period. We find that banks that are in the top tercile of exposure to social media in the pre-period experienced a 6.6 percentage point decline in return relative to the other banks. And in terms of the economic magnitude, this is pretty significant. It's on par, for example, with the effect of 1 standard deviation increase in uninsured deposits. But most importantly, and this is sort of our main finding here, is that social media in our results seems to amplify the effect of already sort of existing and well-documented bank-run risks at these banks. So we find that pre-exposure to social media, pre-exposure to Twitter, interacts significantly with well-documented bank-run risk factors, such as a high number of uninsured depositors and market-to-market implied losses in the bank's asset values. And importantly, when we throw out SVB, when we throw out First Republic from our samples, we continue to find the same results. So this is not sort of a statement just specifically to this one or two banks, but something that seems to be happening broadly in the banking sector around this time. We add a number of different tests that look a little bit more at the underlying mechanisms, that document some cross-sectional patterns to shine a little bit more light on that. What we find is that, first of all, during what we call run period, the conversation on Twitter really is dominated by words and conversation around topics related to run and to contagion. And when we use this run period and the words during that run period to sort of measure Twitter exposure, it crowds out this pre-exposure effect. And I'll talk a little bit more about that in a minute. We do find when we go to the higher frequency that the conversations on Twitter really started with the group of investors, people who use the ticker symbol instead of the full name of Silicon Valley Bank. And then later on, moved to those more commonly used names such as SVB or Silicon Valley Bank in the conversation that happened later. We also do an analysis of the retweets of tweets leading up to the run. And then we're documenting that this is not only something we find in the cross-section, but at a higher frequency, we find an effect of ongoing Twitter conversation at the hourly frequency on subsequent returns. And at the 10-minute frequency, we do find a negative effect of individual tweets about these banks. And importantly, we can tie this sort of back to the structure of the depositors at SVB, looking at Twitter accounts that seem to be people who are in this VC space or in this tech space. Those tweets are particularly impactful and have a bigger effect on the stock returns. All right, so our paper sort of sits at the intersection of a number of different literatures. A lot of models in the bank runs literature have pointed to communication and coordination as an important feature. Our paper indicates that social media can be one mechanism or one platform where this kind of communication and coordination can happen, and adds to what we already know from the literature, for example, about traditional social networks between people who know each other. In comparison to that, social media is something that everybody can easily participate in without having to know the other person. You can actively participate by tweeting, you can passively participate by receiving without having to know the person that you're interacting with, and without giving everyone in the world essentially access to this communication platform. This also makes it different from traditional communication networks or communication methodologies that people have looked at, radio, television, newspaper networks. If you want to tweet about a certain bank, you don't need to own a television network, you don't need to own a radio station to be able to get that message out. And then fourth, there's a growing literature on sort of social finance and social economics, pointing to the role of these social connections for politics, investing, housing outcomes, and we're documenting now that it also seems to play a role for bank stability. All right, so before I get to the results, let me say a few words about measurement and about the data that goes into this paper. The main data source, of course, is coming from Twitter, or I guess I should say X now, but I kind of refuse to. I keep calling it Twitter. So we have 5.5 million tweets that covered the time from 2020 until basically the end of the first quarter of 2023. We're augmenting this with individual tweets that are not just containing those hashtags, but also more broadly mentions of the banks by their names or more commonly used terms. And then those 550,000 Twitter users that post those tweets that we have in our sample. Our stock price data is at the 1 minute frequency and comes from first rate. And then we construct typical measures of bank sort of stability, bank balance sheet risks coming from the bank call reports. That includes, for example, the mark-to-market implied asset declines that are a result of sort of the interest rate changes that happened over the last 1 to 2 years. We're calculating the percentage of uninsured depositors and deposit outflows at the quarterly frequency, as we can observe them from those call reports. All right, so with those data sources in hand, before we get to this relationship of Twitter exposure and stock returns, we first want to understand a little bit better how Twitter exposure in the pre-period relates to the conversation on Twitter during the run period. So the first thing we do is we construct words that capture what people are saying about these banks in the pre-period and relate that to the kind of conversations that happen about these banks during the run period. And we find that specifically banks that had a lot of exposure to tweets related to crypto, that had a lot of tweets in general before the run period, are also the ones that receive a lot of attention and a lot of conversation during the run period. Importantly, though, the nature of the conversation is really, really different. During the run period, the conversation and the tweets are dominated by keywords related to run and contagion and withdraw and things like that. In the pre-period, those kind of words are almost completely absent. We're also looking at the retweets that happened during that time. And what we find is that tweets related to the run are only really started to get retweeted once the run starts. The entire period leading up to the run, all of the tweets that occurred up until the point when the run starts rarely receive any retweets until the run starts, not before that. And that includes tweets that even had information. So there was a famous tweet that become sort of viral now by this account called Raging Capital Ventures that in January essentially posted a 10-tweet series laying out all the issues with the balance sheet problems of Silicon Valley Bank. This tweet did not receive any attention all the way until March when the run actually occurred, and then it became a viral tweet that received thousands of retweets and likes and so on. So from this, we sort of see that there is a relationship between pre-exposure to social media. Banks that had a lot of Twitter activity in general in the pre-period are also the ones that receive a lot of tweets during the run period, but the nature is completely different. So it's less related from this evidence to sort of specific pieces of information and more to a more general exposure to this social media space. Another anecdote that goes in the same direction is related to Bank of America. There was a viral tweet that was retweeted a lot during the run period about Bank of America running out of money. It was sort of a false piece of information that had something to do with sort of ATMs failing. But this ATMs failing tweet came from a couple of weeks earlier. It received absolutely no attention all the way until the run started when it got picked up. Right? So the nature of the Twitter conversation during the run and before is very, very different. All right, now let me talk about our main cross-sectional tests with this in mind. So what we do is, like I said, we split this time period into a pre-exposure period from January until mid-February that allows us to measure the overall exposure to social media. And then we relate that to outcomes during the run period, which is around the failure of Silicon Valley Bank on March 10th. All right, so this is putting the stock price declines of the banks on the left-hand side and social media exposure along with other known bank run risk factors on the right-hand side. And consistent with what you would expect, we find that a higher percentage of uninsured depositors has a negative impact on stock prices. So those banks lose a higher proportion or a higher stock price value during the run. This is on par with the sort of effect of having Twitter exposure in general. We see the 6.6 percentage point higher bank stock losses for banks in the top tercile of pre-exposure to social media. But then importantly, and this is sort of the main takeaway from this table, we find a strong interaction effect here, indicating that Twitter exposure from the pre-period is amplifying those known bank run risk factors, including the percentage or the proportion of uninsured depositors. We do a number of robustness tests around this, dropping banks that are considered too big to fail, replacing sort of pre-exposure generally to sort of startup pre-exposure. That in that case, the effect gets larger, and do a number of other robustness tests here, and it stays pretty similar. We also look in the same framework at deposit outflows. So instead of putting the stock price declines over that period of time on the left-hand side, we put quarterly deposit outflows there. We find something consistent with it, but only among the deposits that are uninsured, which is exactly what you would expect, sort of from the existing literature. And if we replace our measures of Twitter pre-exposure with measures of run and withdrawal and contagion words during the run, that starts to crowd out the effect of pre-exposure, indicating again that there's sort of a relationship between Twitter pre-exposure and the amount of activity that happens on Twitter during the run on these banks. All right, so of course the statement and these conclusions sort of merit a little bit more of an identification, a little bit of a closer look at changes during the period of the run. And so that motivates us to go a little bit more high frequency and look at the changes in the stock prices over time around the occurrence of this bank run on SVB. So first of all, we want to understand who is starting this conversation, who's sort of driving this Twitter conversation on social media here. We see that on these lines, the people who first started to talk about this Silicon Valley bank run are the ones who are using the ticker symbol SIVB, and that's then followed by the more general discussion using the more general term SVB and Silicon Valley Bank. So one piece of evidence that this conversation sort of originates with the investors rather than sort of the general public. And next, we would like to understand sort of the effect of ongoing Twitter conversation throughout the run, for which we zoom into the hourly frequency. So this is going to be a panel basically at the hourly frequency with hourly stock returns on the left-hand side, and then measures of bank run risk that is pre-existing before this run period on the right-hand side, along with ongoing Twitter conversation through this period around the SVB failure. As you would expect, stock returns are sharply lower after the onset of the run after March 9th. As you would expect, this is particularly strong for those banks that have higher balance sheet risks. So here we dub balance sheet risk just as the interaction of uninsured deposits and mark-to-market losses, combining those two sort of traditional bank run factors. Those are all things that you would probably expect. The important takeaway from this table is that when we start to interact, the interaction of after the run starts with higher balance sheet risks, with is there a lot of Twitter activity during that time or not, we see much more negative effects here, indicating that ongoing tweets throughout this period are amplifying the effect of these existing risks. We can do this by excluding SIVB, I get the same results. We can include lagged returns to make sure that our Twitter activity is not just reflecting previous returns, but actually telling us something about those 1 hour down the line returns, and do shorter time windows, the results stay very similar. In fact, if you take all the banks and you keep only the ones with high bank balance sheet risks, and then you split that sample into two groups, those with a high amount of activity on Twitter during the run and those without, you get this picture right here, and you see that the difference in the stock values really starts widening. That gap really starts opening up right around the time when the SVB run begins, and then widens over the next couple of days to the point where the banks that are both groups here are in the high balance sheet risk group, but one of them has has higher number of tweets during the run, and that's the group that loses almost double the value in stock prices during that time. All right, with the remaining 1 minute that I have, I'll just point you to the fact that we also do a high frequency analysis where we construct stock returns in a 10-minute interval beginning 5 minutes before the tweet was sent to 5 minutes after the tweet was sent. And then we relate those 10-minute stock returns to the sentiment of the individual tweet that we pick up with the Vader score, positive and negative. We do this once or twice for the entire sample of tweets in 2023, and then just for the sample of tweets that comes after the beginning of the run. As you would expect, first of all, before the run, tweets on average are sort of the returns around these tweets on average are 0. After the run period begins, the returns on average are very, very largely negative. Importantly, though, the key things here are that negative sentiment in the tweet matters particularly when it comes from a startup tweet, when it comes from a person that where the Twitter profile indicates that they're a part of the startup industry, and when it includes words related to contagion and to run. And this also holds when we dropped SIVB and First Republic, again suggesting that this is not like a specific effect for this one particular bank. All right, in conclusion, what do we find? We do find that Twitter communication and coordination have an imprint on this SVB run period. We find that the conversation on Twitter seems to amplify already existing risks that have been documented in the literature, and this seems to be coming particularly from those kind of tweets that are related to the startup community and the tech community in this particular case. All right, thank you very much. Looking forward to the discussion.
It's such a pleasure to discuss this paper. So I'll start with what I really like about this paper. So the page down doesn't work.
Click with the mouse.
Oh, only the
Click
mouse.
on it, yeah.
So I actually hope that empirical studies will have more of this feature. So the paper actually constantly goes between an empirical finding and what I call a poster child story. So a poster child story is a narrative of a story in a reality that will be a glove fit to the narrative of the empirics. And this paper does it so well, chapter by chapter. Now, the second one is that if you ask a layman what is a bank run, and people will tell you, well, people rush to the bank, try to redeem their deposit. But this paper goes one step and tries best effort to separate a coordination failure from a fundamental weakness. Okay. Now, I would think this is a wonderful paper to read because it really capitalizes on a dramatic event, advanced both the bank literature as well as the run literature. Okay. So let me set up a stage and review a little bit what exactly we mean by bank run. Okay, so as I said, generally, if you see depositors rush to withdraw their money because they expect the bank to fail, we call it run. Okay, but if we go back to Diamond Didvig, it seems the bank run should go beyond just people rush to redeem. Okay, so a run equilibrium should include redeemers who would prefer to keep their deposits in if they did not expect other people would redeem. So it has to be a coordination failure. Now, the second one is that a run has to cause real economic damage in addition to merely reflecting the underlying distressed situation. Now, this is a theoretical abstraction, and in reality, the two ones are usually intertwined and very difficult to separate. It's very difficult to run on a perfectly healthy bank. So this is why the late bus story is a urban legend rather than a real story. So if you heard about it, is that the bank, outside the bank, there's a bus station. One day the bus was late, people line up to wait for the bus, and there's a rumor say there's a run, and the bank run started. Now, after some investigation, Google everything, I was convinced it didn't happen, but it was an urban legend. Okay, so the solution that you always need to have a super big lobby of the bank so that people don't line up on the street. But with social media, even this would not help. Okay, so this is why in empirical, there's always challenge to exactly isolate this strategic complementarity, not just the action of running to the bank, you run to the bank because you think other people will run to the bank, instead of a mere information dissemination, whether the information true or misinformation. Okay, so this is a really a challenge, and very few empirical work would completely accomplish. I think these papers get so much closer to that separation. Okay, so when I'm putting the tweets, it reminds me of two papers. So bank roundings are two types of round. One is called a Calamirez and Mason round. So that was a paper, empirical paper, and basically they look at the banks failing during the Big Depression and show that the failed bank indeed deserved to fail. So that's a fundamental weakness. Now the run could expedite this failure. So in this, under this hypothesis, the Twitter would speed up dissemination information, leading to a quicker failure of a fundamentally insolvent bank. Now the second round is the ghosting and the Posner round. It's basically Twitter communicated intention to run and destroy an otherwise insolvent bank with liquidity mismatch. Of course, every bank has liquidity mismatch. This is the sole job of liquidity acquisition. Okay, so the authors made a very conscientious separation too. I think in the writing, actually, the effort is more conscientious than the presentation due to the limit of the time. So the two are really hard to separate, because when you disseminate information, you also created this high order belief. Now I know they know, so that we can run together. So I would say it's really impossible to separate, but we can get closer and closer to that separation. Now, one thing they outline as an interesting observation is that the Silicon Valley Bank was not even an outlier in terms of asset decline of mark to market, but it's the interaction with both Twitter and percentage unsure that created this deadly outcome. Okay, so I think my key comments is about what are the sources of variation behind tweets, because the pre-event tweet exposure is treated as a conditioning variable, but we need to have a better understanding why some firms had more exposure than others. Okay, it could be a completely sunspot equilibrium, but maybe it could be something else. Okay, so the Twitter exposure is recorded pre-event, okay, but it doesn't imply that it's not correlated with certain bank trades will be associated with the vulnerability to runs. So when I think about people's attention, what people gossip about, right? I would think items or things or securities or organizations or people, kind of what I call in the fulcrum position, are more likely to attract maximum amount of attention. So what is a fulcrum position? Fulcrum position is basically the tip point. Now I'm a soccer fan, so I follow the tweets on English Premier. I few tweets following Man City because they win every game. Few tweets following Luton because they loses every game. So what do tweets gossip about? They follow the team that on the margin make to Europe, on the margin to become relegated. Those are called the fulcrum teams. So now I think the argument will be, can we show that the pre-tweet event actually were not sorted this way, so that later the effect will mostly be causal? Now the two words clouds, these were the words before, these were the words after. You can see this has nothing to do with vulnerability. This has everything to do with vulnerability. However, this is an aggregate pattern, but not a event versus placebo comparison. So this is something I think authors could go on to show more. Okay, so it's always cheap to discuss and say, hey, this is not exogenous. But I think my comment is here is that if I were to do this analysis, what I would do in addition to what has been done that can make it more convincing. Okay, so I think it would be great to have a formal test on the vulnerability comparison at before the events. Okay, so for example, the ex-ante vulnerability, or expose asset drop, but ex-ante vulnerability is really the percentage of how to maturity. Because if you have a lot of assets, how to maturity, then they're not marked to market, and any market price change would create a huge vulnerability to the bank. And of course, the other uninsured deposits, the extent that the bank conduct interest hedging. We would like to see a formal like covariate balance test to compare the high exposure bank versus low exposure bank at time t-1 along these dimensions. Okay, so if that is fully balanced, then I think it's much more convincing that the trader exposure generated this round-like behavior. Okay, now the next one is that it seems the stock investors got it. Stock investors react immediately and penalize the price of the stock price of the banks that have those vulnerabilities. So the question would be, why do stock investors understood this mechanism so perfectly, but not the trader posters during the pre-event time? So if the trader posters also understand the mechanism as the stock investors do, then the exposure to traders should potentially reflect this vulnerability, even though not materialized before this event. Okay. Now the next one is a little bit more discussion on this proxy that assigns stock returns to be equal or changeable to redemption. So we don't observe high-level redemption. There's nothing we can do, and this should not stop researchers from writing a great paper. So the authors using high-frequency stock returns to proxy for redemption. Okay, I think this is the best effort comeback. But we can do a little bit, go a little bit deeper to make sure that proxy indeed is tightly matched. Okay, so the reason there's a challenge is that the stock price reflects both fundamentals or fundamental plus run risk, and we actually don't know what's the composition of the two parts. So what I can see is that we can have a variance in the combination of figures 8 and 9. It's basically for each bank with high social or trader exposure, we find a low exposure bank with similar percentage of mark-to-market and similar percentage of uninsured. And then you see the divergence afterwards. Now, even after that, I would still like to see a discussion that separates bank run from the papers I outlined from market run, Akka, Bernardo, and Welch. So Bernardo Welch pointed out, even when there's no bank run, there still could be a market run. Meaning I sell the stock because I anticipate other people will also sell the stock, and I expect the stock price would not recover in time when my liquidity constraint becomes final. So that is the mechanism of market run. So here we have to rule out that this was a market run because the testing variable is stock price. So I have to rule out market run so that it is meant to approximate a bank. Now the last comment is just my own curiosity. So we know that concentration liability in banking has received far less attention than concentration. Everybody think about concentration assets. You don't put all the eggs in one basket, but nobody teach you do not all old eggs from one basket. We don't talk that way, right? So we can also think about concentration liability as well as the assets. Now, there's again the theory paper by Cossetti, Discussant, Morris, and Jiang. The title was "Does One Soros Make a Difference?" So the argument is following. So Soros is a gigantic investor. So the talk about there was a currency run of the British pound during that years, an argument that if we can have one Soros, there will be no currency run. Because Soros is so big, if he runs, he will be running on himself. So if you have a big player, right, the big player will coordinate with themselves to avoid a Pareto inferior equilibrium. Okay, so when I read the paper, I say, gee, didn't we have a Soros here? And that's Peter Thiel, right? But guess what Peter Thiel did? His portfolio founders and tell them run. Okay, and after he took his portfolio companies, and then other VC funds reportedly follow suit, right? So he could be a Soros. So what I learned from this story is that it seems Peter Thiel effectively coordinated wrong on himself and his followers, right? And he obviously would know the effect of his action to the probability of wrong. So he's endogenous to the probability of a wrong because he's a Soros type of player, right? So he should do so if he were rational. He should do so only if he believes that the bank is fundamentally insolvent. That's why he coordinated wrong on his own followers. Okay, so this is related to a paper by Santos Zinales that shows that SVB was insolvent before the bankrupt occurred. Now, I don't necessarily buy that view, but this is a view, okay? And it seems Peter Thiel's action would have supported that view. Okay, so and what time on?
I think the clock restarted.